future, talk radio will actually educate, inspire, and make you think. The future is now. Topics and music that affect your life from Universal Broadcasting Network. Tune in at ubnradio.com.
Jump off that exhausting hamster wheel and into balanced living with Dr. Marissa.
Promise you joy in the mystery.
Dr. Marissa, also known as the Asian Oprah. Her mission, to be a beneficial presence on the planet. Her purpose, to be your personal advocate to live, laugh, love, learn. Her life motto, don't die wondering. Take back your life with Dr. Marissa Pay.
And welcome. You are tuned into my weekly talk radio TV show called Take My Advice. I'm not using it. Get balanced with Dr. Marissa every Tuesday at naturally high noon out of the Sunset Gower Studios in Hollywood, California with UBN Radio TV, Universal Broadcasting Network, and then on Saturday at 2 on my CNBC, NBC News Radio syndicated channel KCAA. AM 1050, FM 102.3, FM 106.5, and on demand everywhere on iHeartRadio. And this is a show about hope and happiness. So there's no gossip, no scandal, and no K words, no Kardashian talk at all, because I want you to focus on your own reality show and how you can be happy 88% of the time. So if you've missed any of my shows or topics that help you be happier 88% of the time, Fran Drescher's show on how to reduce your risk of cancer, Corey Feldman in surviving a lot of stuff in his past, to Marianne Williamson, to Marianne from Gilligan's Island, Neil Donald Walsh, you name it. I have the full spectrum. It's kind of like a cross between PBS, Entertainment Tonight, and CNN News, balancing out the constantly negative news with good news. So please go to my YouTube channel to a free subscribe, or iTunes or iHeartRadio podcast, you name it. I am everywhere. You want more hope and happiness. And today's show is no exception. In fact, today we're actually going to talk about something kind of important to everybody, and that is money. And I guess we could have queued up that money. No, that's okay. I wanted to bring someone on to really talk about money, because a lot of us are a little gun shy around what has happened to the money. We don't want to have what happened in 2008 happen again. We're not sure with all the, bailouts and the banking system and all of the old BS belief systems about what to do with money. So I thought I would bring on Lorraine Ell, who is the CEO of Better Money Decisions and Better Insurance Decisions. As co-owner of B$D, she is excited to continue her long career as an investment professional, which started when she worked in the 80s with as an advisor for Drexel, Burnham, and Lambert, and J.W. Charles as co-owner of a registered investment advisory firm. She's also the author of the book Bozos, Monsters, and Whiz-bangs, Bad Advice from Financial Advisors and How to Avoid It. Lorraine is frequently quoted on MarketWatch, Investment News, Investors Business Daily, Yahoo Finance, and the Wall Street Journal. So, without further ado, please welcome to the studio, Lorraine Ell. Welcome. Hi.
Thank you for having me.
Of course. Took a little bit for Katie to work her magic with us, but it worked. And I was on Katie's show the day of my book launch, which was awesome. Wonderful. Yeah. And so that's why I asked her to come on. She's like, no, I want my friend Lorraine to come on. So that's why you're here. And I can't think of a better person to talk about money. So let's start with, why did you write a book about Bozos? I guess is the good opening question.
Well, these are just some of the choice names that I've come up with to highlight some bad practices by financial advisors and some of the horror stories clients have come to me with over the years. So I call them Bozos, Monsters, Whiz-bangs, and a few other names that I won't mention right now. But
Yeah.
yeah, is that be cautious, be aware, know that if someone is treating you the way you see clients being treated in the book, that's not the way it has to be.
So,
and that there are better advisors out there.
so what is happening? So I'm guessing that people, who are investing money with people who you think are supposedly experts, you give them your hard-earned money, and then what's happening? People embezzling, Bernie Madoff. I actually had Janine Roth on her on my show, and Bernie Madoff made off with 10 million of her hard-earned dollars.
Dear, I hate.
Yeah, so that's the kind of stuff you're talking about. So let's talk about Nurse Betty.
Right. So Nurse Betty is the start of the book, and she's the first person I talk about in the book. She brought in a stack of confirmations, and confirmations are the notification from an investment firm that you have either bought or sold a particular investment. So she brought in a stack that was almost 7 inches high and plopped it down and said, I don't understand a thing my advisor is saying to me. And we've had a really good market and I'm just not making any money. So when I looked at what she had there, it seems as though the advisor was something called churning her account. In other words, he was buying and selling investments for his gain and not because it was the best thing for her to do at any particular time. It's this kind of thing. Not necessarily is something you're going to recognize, but certainly something that you should be aware of. If you find that an advisor is frequently trading your account, that is totally not necessary to have good returns.
Okay, so there's the first BS, the belief system that in order to manage your account well, you should be buying and selling very often. So that's not true, is what you're saying. Okay.
That is correct.
Okay. So what about diversification? Because that's something that comes up all the time. You need to diversify. You need to be in different markets. You need to have a diverse portfolio between stocks and bonds, and then some CDs, some whatever. And then across different markets, differentiating between healthcare. I mean, it is very understandable why people leave their money under the mattress. Because, and I have to be honest with you, when you look at the CDs, I remember years ago, without saying how old I am because I'm ageless, but the returns on CDs were like 10% or something, and now they're like 0.05 or 4. Why would you even put your money in an investment like that?
Well, I mean, this is why you have to really pay attention to the current circumstances. So you are right. I mean, investments back in the 1980s, when I started in this business, you could get CDs that were paying 10%, 11, maybe 9 or 8 as the decade went on. And for the longest time, since the 80s, we've had falling interest rates. And what that means is we've also had falling returns on things like bonds and CDs. Well, this past year, that started to change because now interest rates are going up again. So you have a situation where CDs are now paying 2% or 3%, depending on how far you go out.
Mm-hmm.
It's good maybe for past generations or past decades is not necessarily good for now. But that whole idea of diversification is a concept that you really need to embrace. But to do so, you really need to understand what it means. A lot of people confuse diversification. They think that if they have 20 different mutual funds in their portfolio, they're diversified. But that's not necessarily true. You could have 20 different mutual funds in your portfolio, and they're all similarly invested. important to really dig deeper and to look into those funds to see exactly what asset classes or what countries or what part of the world or what industries you're actually invested in order for you to have that true diversification.
So where does the buck stop where, you're paying somebody to advise you? So you're trusting them to do the research, right? You're trusting them to know, but they don't really know because you're not 100%. Like, how do you even know who to go to advise you? Because, nobody talks about their track record necessarily, or, no one's got a perfect track record. So they may have a great track record with one person and then they lose money for you once you go with them. So, again, it's so easy to just say, I'm putting my money into the mattress. There's no guarantee, right? There's no guarantee. How do you know what to do?
Well, the one thing you really need to look for and be aware of, and to ask an advisor who you may decide to work with, is, are you a fiduciary?
Okay.
Because a person and an advisor who's a fiduciary must, by law, act in your best interest.
Now there's a good thing to know.
We're all fiduciaries.
Okay.
We have to do the right thing for you.
Okay.
That's something that if you find that out from the person you're working with, that will go really far to at least know that they're telling you the truth. They're looking out for your interests first.
Mm-hmm.
That's what will make a big difference.
So are they licensed to be fiduciary, or they go to school to be fiduciary? I've never even heard this word before. So
no, you are. It's a particular structure. So in our industry, we have a couple of different categories of advisors, and of course, we all call ourselves advisors. So how confusing is that for the general?
Right.
You can't even tell by the name,
right,
if the person is a fiduciary or not.
Yeah.
But if someone has a Series 7, that's the exam they pass, and they are working for one of the big brokerage firms, and we've all heard their names, they're all on TV, not necessarily fiduciaries at all. If someone is a registered investment advisor or works for a registered investment advisory firm and has a Series 65, those people have to be fiduciaries under the Investment Act of 1940. So there are two separate laws that govern our industry. And you can tell by first asking the question, but also exploring what licenses the person has. For an insurance person, you're not a fiduciary. If you're a Series 7, you're not a fiduciary. If you're a Series 65, yes, you have to act in the client's best interest.
What would be not acting in the client's best interest? Like the charmer that you talked about is not acting, right?
That is correct.
Okay.
And for someone who's an advisor with just a Series 7, they are under what is called the suitability standard. Is the investment suitable for the client? It doesn't have to be the best thing. It just has to be okay.
Mm-hmm. Okay.
And there's a big difference in that. There's a big range of investments that can be okay, but that doesn't mean that it's the best for you.
Right. I mean, one of the things that I think I know is when you're asked, are you a high risk, medium risk, low risk? So for those of you who, are suddenly into some money that you want to invest, see if I've got this right. So if you have steady, like 6-figure, 7-figure income, you can afford to do some high risk investing. If you are eking out an existence and you've saved maybe 5,000 or 6,000, you're a low risk investor. Is that accurate?
Well, yes and no.
Okay.
So I liken it more to Goldilocks.
Okay.
So, you know how Goldilocks tests the porridge and it's too hot, and she tests another one and it's too cold, and then she finds the porridge that is just right. That's what you need to do as an investor. And it has less to do with how much money you work than what the money needs to be for and how much time you have to invest those funds.
Okay.
The longer time that you have, if you're a 30-year-old who is just going in and starting to invest, maybe starting with a 401k with your company, you can afford to take a little more risk than even the very wealthy millionaire who's in his or her 70s. And, you know, that money has to be used to live on for the rest of their lives. So there is a level of risk that's going to be just right for you. And a good advisor is going to help you find that level.
Okay. So let me give you great answer. Let me give you some application ones. So let's say, because I have a huge range of listeners. So I'm going to start with I've got millennial listeners who are basically, freaked out already about their ability to get a job. They are making minimum to a little bit more wage. And they've put together, they're good savers, they live at home. So they've saved $4,000 or $5,000. So what should they do with that money?
Yeah. So, I understand a millennial has quite a bit of time to go before they probably need to use that money for retirement, for example. So if you're saving in a 401k, and again, this goes back to what's the purpose for the money?
They're probably not going to be in a 401k because the average millennial does not stay in a job. I think that it's 2 years from what I heard on the research. Okay. Or
but is the money? Are they thinking of this money to save for retirement?
Well, my guess is, and I just had a discussion with one on the red carpet. They're anxious about, not having the money. So investing money where they can't get at it, or I guess I'm wanting to encourage them to do something with the money that might make it grow versus spend it on another piece of technology.
Right. Well, it's always good to have at least an emergency fund that you can tap into if you need a car repair or you need a dental bill, and try and pay for dentists. I mean, that can run at least $1,000, $1,500.
Right.
So
that's
have that kind of savings account.
So that's a great thing. I'm glad you brought that up, because when not trying to date myself, but there was a ratio that people would say you need to have 3 times your monthly, or 6 times, whatever it was, 3 times what your your monthly nut is liquid. Is that still true?
Yes, it is.
Okay.
And I would classify that as an emergency fund.
Okay, that's what you're talking about.
Fund that if you lose your job, you have, a car repair, you have a medical bill that you have to pay for that's unexpected. It's good to have between 3 and 6 months of your salary put away in something very liquid. Now, the fortunate thing is that now, with interest rates going up, you can open an online savings account and make almost 2% per year on that money, which is better than it has been for a long, long time.
Yeah.
I think that's job number one.
Okay.
To put your money, at least that amount of money, away where you can access it quickly and not have to worry about the volatility of the market.
Great. Next. Okay, so that's one. So let's go to the next level of they are young professionals. They work hard. They are consultants. Okay, so they don't have a 401k. They don't want to work for anyone else. They get 1099s. They have maybe $50,000 that they have the ability to do something with. So
Okay.
what should they do?
Well, if they're professionals and working on their own, they should set up either an individual 401k or a SEP IRA or a simple IRA, because they should have that money working for them tax deferred until they need it when they stop working or retire. And in those cases, then they can start taking a little more risk with the money. And if they want to have enough to retire in their later years, it's important to have a mixture of stocks and bonds in that account.
Mm-hmm. Even when 2008 happened, even though, with the state of our nation right now, we're not sure how our economy is doing. Even when companies have not demonstrated fiduciary responsibility, boards haven't. I'm sorry. Normally I'm very positive, but I'm playing devil's advocate here. Even when you can't, every news piece is about, companies going bankrupt or stealing the 401k. You still believe in the traditional investment of stocks and bonds?
I think if you want to keep pace with inflation, you have to invest in equities. And over time, even for people who felt that, and perhaps did the wrong thing by selling out their investments in 2008 and 2009, because if they had hung in there by 2011, they would have been back to even. And then since 2011, the market has done tremendously well. I'm saying that stocks aren't volatile. They are. And markets go through cycles and they have ups and downs. But historically, over time, you can't beat the returns that you get from being in equities and U.S. and international stock markets. They provide the best return. So there's always a case to be made for having a portion of your investments in something in the stock market.
Mm-hmm.
Now, everything, and not individual stocks, because you're right. If you have an individual stock, who knows? I mean, it could be the next Sears. It could be, from those of us who remember, Eastman Kodak, or something, that has now gone belly up. I mean, GM had a big problem back in 08, 09.
Mm-hmm. Well, see, that's the thing. Yeah. So it's kind of like armchair quarterback, though. I remember in 2000, it's like, if you had hung in there, of course, but if there was something to hang in, if you didn't cash out like $2 versus $0, at least you had something from that initial $10 a share kind of situation.
Yeah, but remember, if you just hung in there for a little bit of time, and if you are someone who is nearing retirement, you need to make sure you have a big portion of your investments in assets that are not as volatile as the stock market.
Mm-hmm.
So had some short-term bonds and some cash and some shorter CDs during that 2008, 2009.
Mm-hmm.
You have had to sell the equity side or the stock side of your portfolio. Just let that ride, but still had access to cash.
Mm-hmm.
So it's a balancing act again. It's the same as the porridge.
Yeah.
Find the one mixture that's just right for you.
Yeah. Yeah. Well, it's definitely one of those, I still have that, the cynic part of me. It's all, investing is like a crapshoot. You really don't know for sure until after the fact. And do you really, do you have that kind of money to play the stock market? It's like gambling. It's legalized gambling. Now, I've heard this. Legalized gambling, and you just, you throw your money in, and hopefully you'll hit something that goes crazy. I have a little story that I'll tell you. this is kind of embarrassing, but it has a happy ending. I I was not thrilled. I had tried with some advisors and they did not do well for me. So I said, you know what? I'm just going to try this myself. And I went, and remember when they all had the numbers in the paper, and I would go and see the lows and the highs and all that. And then I thought I was thinking that I would invest in an airline. I think it was I was looking at, it wasn't American Airlines. It was some kind of airlines. And I accidentally bought stock for American Eagle. Oh, it was American Eagle Airlines that I was looking for. And I ended up buying American Eagle Outfitters, which is a clothing company. But I tripled in like 6 months. It was crazy. So I accidentally did really well in the market. So, but we're going to come back after break, because it really, truly, I do want, because I do believe you and hear you, and you definitely are one of the most credible financial advisors I've ever talked to. So that's a good thing. Yeah, I didn't tell Katie that, I was not a real believer in this stuff, only because I didn't want to freak you out at the beginning. But now that we've had this session, when we come back from break, we're going to really ask, the safest way and the most moose on the table way, which is my Canadian version of elephant in the room. Really, how do we safely and in a balanced way energize our money energy? Okay, so we'll be back in 2 and 2 to thank the sponsors that make this show possible. It's all about balance, peace in and peace out. That's world peace through inner peace. We'll be right back. Are you ready to break the cycle of your addictive behavior? Have you tried other methods but still feel stuck? Patches, hypnosis, therapy to no avail? Well, TJ Woodward is ready to help you with conscious recovery, helping you recognize core false beliefs that are keeping you from a pathway of life filled with love and connection. Contact TJ at www.tjwoodward.com to free yourself today. Do you want to be happier in life than you are now? Well, Dr. Marissa's newest book, 8 Ways to Happiness from Wherever You Are, will help you unlock the BS, belief systems that say you are not good enough. Hitting 6 bestseller lists, including #1 on Amazon and 3 book medals, this self-help on steroids book will help you be happy 88% of the time, which is your birthright. Go to 8waystohappiness.com today. And we are back. We're having fun with our sound levels today. This is Dr. Marissa reporting live from my own studio and not the red carpet for a change. I am here at Universal Broadcasting Network at Sunset Gower Studios live every Tuesday at noon. And then if you're watching the rebroadcast on my syndicated CNBC, NBC News Radio channel Saturdays at 2 p.m. Out there in... where are we now? Redlands, San Bernardino, and everywhere in northern San Diego County. KCAA is everywhere. I think we cover like 6 million listeners in Southern California. But anyways, this is a show about hope. And so there's no gossip, no scandal, no K words, no Kardashian talk at all. This is Take My Advice. I'm not using it. Get balanced with Dr. Marissa. And today we are talking about money, 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 money. So I am really putting Lorraine Ell on the hot seat, but she can handle it. She is the CEO of... Better Money. I'm sorry. I just lost my Better Money Decisions. You have a little dollar sign, right? Instead of money. So that's throwing me off here. But she's been giving great advice on what to do with money in different situations. Some of the old that still applies, some of the new. And what would you say to people who really are, a little afraid of investing money now.
Yeah. And I understand how it's frightening, especially if you're not educated or don't understand how to invest or how all of these markets work together. It can be intimidating. And of course, I think that it's part of my industry to confuse and to obfuscate and to make it sound a lot more difficult than it really is, because it isn't that confusing and can be broken down in some pretty simple terms.
I'm learning all kinds of new words today. Obfuscate? What is that?
Obfuscate?
Yes. Tell me what that means.
Muddy the waters to confuse people.